We go. Welcome back, everyone. Today we've got Lance. So first time actually talking to him, which is awesome because I followed him through the COVID process, and he was one of the sources that I would go to for information that was accurate for real estate. And so I'm really happy that we have him here for you today because he's going to go over the differences in markets so you can see how challenging it really is to be able to tell what's actually happening because it gets confusing. People get into arguments and then opinions come out and then it gets so much fun on the internet. So Lance, thanks for doing this, man. I appreciate your time.
Thank you so much for having me. Housing. Always a lot going on. A very interesting time to be covering the housing market and, for all the professionals working in it as well. Very interesting time right now.
Lance, before we get started, I know you started a newsletter, a paid newsletter called Resi Club that I'm part of. And I love that, dude. I use it often. I go back to it and I send clips of it to some people. I'm like, no, you got to check this out. So, how do people join that?
Yeah.
What's the link?
So if they go to resiclubanalytics.com or just Google Resi Club, you'll find it. My website, if you just go to the front and you drop in your email in the search bar, you'll get the free newsletter during the week. But then also there's 3 additional pieces, access to my trackers, and more reporting for the paid members who upgrade to Resi Club Pro. And what I cover essentially is regional housing markets, get really deep into the data. I have great maps, interactives for people to kind of look around and compare markets. And then I also really cover the institutional side better than any of the other publications, in my opinion. Watch closely the home builders and then prop techs, real estate startups, and kind of figuring out what's going up in the space. Not as much into, like the broker lawsuits and stuff like that. I'm more focused on the
The
single
data.
the market. Yeah, the actual market.
And that's what we need, dude. I don't care about what the hell's happening with Keller Williams or another company. It just doesn't matter to me. What matters is what's happening with the market. So what is happening right now that we should be looking at from what you're seeing?
Yeah, so what we've seen in the market is we've seen a historic deterioration in affordability. That'll happen when you have an overheating on price during the pandemic rush, and then a mortgage rate shock to follow it. And so the affordability is deteriorated, and what's translated has not been a big pullback in price, although there are some markets that have certainly softened in places like Texas. But what we have seen is a very sharp pullback in resale transactions. The churn in the market is reduced. There's fewer people who are going out selling their home to go buy something new. And the reason being that affordability would be a huge hit for them. They have a 2-3% mortgage rate. The net effective rate of all the mortgages in the US is 3.6%. And so when you have a market where there's high sixes, 7% mortgage rates, it would just be a big their monthly payment would go up a lot, trading in that mortgage rate. And so churn is reduced in the marketplace. The builders during the pandemic, their margins hit all-time highs. They were making more money than they were during the housing bubble era. The pandemic time was great for them. And the reason being is there was just not enough on the market, and homes were selling so fast, and there was such a rush that they had complete pricing power. And so builders had big margins. So when the mortgage rate shock occurred last year, what they did is at first they did take a hit. There were new home sales came down and they were feeling it. But very quickly, they did affordability adjustments. And what they found this cycle is the affordability adjustment that it works is mortgage rate buydowns. So they came down a bit on margins and they improved affordability with these buydowns. And it really is the big builders who benefited the most. The ones like D.R. Horton, Lennar, Pulte Group that have in-house mortgage companies. They really are the ones that benefited the most.
Are
And
you? Oh, go ahead.
and so that's where I kind of see this market right now is the single family construction side is stabilized and they've been able to improve some affordability to continue sales. the resale side of the market is very constrained because it doesn't make a lot of sense to sell their home to go buy something new. So that's where the status of the market is today. What we have probably seen is I believe that the decline in new listings is probably behind us in terms of the big drop. Like the big drop has occurred, and that listing deficit is actually improving a bit year over year. If you look at November 2022, there were 74,000 fewer homes that came up for sale in the United States than in November 2019. 74,000 homes, just
Wow.
in November 2020. And so that minus 74 was November 2022. November 2023, we still had a listing deficit, but we were down 54,000 from 2019.
Oh,
So
okay.
so there's
Interesting.
so there's not a lot, the new listings are very constrained, but it's improving a little bit. And so hopefully what's happened is the fact that we have gotten potentially with the peak of mortgage rates behind us, like that 8% should hopefully be the peak for the cycle. Now
Hmm.
that that's behind us and mortgage rates have been elevated for a bit, there's probably some level of acceptance where people the past couple of years who didn't sell their home to go buy something new are kind of like, you know what? We had another kid. We really need space. We've been putting this off. We were
Hmm.
never going to do an 8% mortgage rate or 7, but you know what? Giving up our 4 or 3 for maybe a low 6 or high 5, if we pay down with some points, maybe then they'll make the move. So I think acceptance and the fact that mortgage rates have been here for a while and have probably gone past the peak is helping new listings to move up a bit. But at the end of the day, it's probably going to be a fairly constrained housing market in 2024 in terms of resale transactions. Hopefully it maybe moves up a little bit off of that, bottom, but it's probably not going to soar back to, definitely not to the pandemic levels of resale transactions. And it's probably going to take a while to even get back to like 2018, 2019 levels. It could take years.
So with the constrained market in 2024, you're seeing then prices remain pretty stable because I've seen some predictions from like Zillow or Redfin or I think it was Morgan Stanley. I don't remember. They're in the either 0, 1%, 2% increase, or even in some cases like negative 1% increase in totality for price increase for homes. What do you think? Do you think it
Yeah.
remains around that price?
So the models, if you take them all, you have Moody's Analytics is a little more bearish, and it's been because they think the fundamentals are straining the market, and they think there could be some price give up still. But they didn't get that right last year. And Morgan Stanley still thinks there could be a little bit off. They think 3% down this year.
Yeah.
Although they also, I just listened to their economist come out, and he said that -3 is beyond that. There's probably not much even downside past that. So worst case scenario, he doesn't even think it would go too much beyond that -3. And then most of the models are kind of in the 0, +1, +2, +3, +4 range. But you know what I would do with all of those? I
Hmm.
would take them all, crumble them up, and throw them out. Because at the end of the day, the truth about the housing market is one, we have stabilized in a lot of ways from the price declines that we saw in the second half of 2022 into the very beginning of 2023. We've kind of stabilized off of that. And the truth is, in the market, usually when active listings are this low, and we're at like 3, 4 months of supply nationally, home prices usually rise. Now, if you zero in on the markets from Wisconsin, Illinois, and can I share my screen?
Oh, please do, man. I want to see numbers.
So this is how I think about it. This is active listings. Now, earlier I was talking about new listings. New listings are the supply coming on the market. Active is what's sitting on the market. So if a market weakens, like Austin, Texas, actives can rise even if new listings are down. So Austin, Texas has seen new listings from 2019 levels come down 20%, but active listings are above pre-pandemic levels because homes are just sitting so long because the
Got
market
it. So
has weakened so much.
if we're looking
So
at this, the green is the shift in active listings have gone, inventory's up. The gold,
inventory,
darker brown, it's lower.
yeah, from 2019. So
Got it.
anywhere that's green is actually not only gotten back to 2019 levels, is above. Anywhere
Whoa.
that is brown is under pre-pandemic levels for inventory. And so the reason I said take all those forecasts and crumble them up and throw them out is a lot of these ones that you might see that are negative, they don't apply probably if you're in Wisconsin, Minnesota, Michigan, Indiana, Ohio, West
Yeah.
Virginia, Virginia. I mean, a lot of these, and then even in parts of Southern California, inventory is just so low that the
So,
technicals of the market, and this part is kind of important, the technicals of the market, when you get into that seasonally strong period, the spring, will probably push prices up. I never think of inventory. This is one key thing that I have a little bit of a difference on housing analysis. I never think of inventory as supply. I think of it as supply and demand. It's this equilibrium, and it
hmm,
tells you where that market is. And so the markets where you're down 80% inventory wise, like Hartford, Connecticut, that supply demand is in balance. And it's in imbalance in a way that's probably going to push prices up if everything is stabilized in the market.
all right, I have a question then, man, because I'm seeing a story here. Why why are the two northeastern, even north midwest, and the southwest so golden and yellow? What the hell happened?
Okay, so one thing about the Northeast and Midwest is those parts of the country, there's not a lot of home building. There's not a lot of single family building going on in those markets.
Mm-hmm.
And a part of this is because the long-term demographic outlooks, the builders, they're not really into it as much, is where the Smile States, Texas, Arizona, Florida, Georgia, into the Carolinas, those places have a lot more construction occurring. And so when you have a mortgage rate shock like last year,
Mm-hmm.
and the shock occurs, and if you have a lot more of the supply in the pipeline, that can, as it comes in, it can kind of weaken your resale market, this existing home market, and can
Got it.
kind of push up inventory. So that's one of my beliefs. Out west, um, I believe the western half of the country is probably the part of the country that has the most acute housing shortage. And what that's done over the past decade is it's pushed prices way up. And couple that with low interest rates, which has kind of juiced that side of the country's economy because very
Yeah.
tech, there was that huge tech boom over the past decade. So prices in the western side of the country really took off, right?
Mm-hmm.
And so last year, if you remember when mortgage rates went up a lot, prices came down the most in the western half of the country.
Yeah.
And why I believe that is because affordability there was so pressurized. People were stretching themselves so far to their means just to buy that when that mortgage rate shock occurred, it just pushed prices too far over. And they came back a bit. But the reason I think they stabilized so fast is that while affordability has really deteriorated there to levels that are actually beyond history out in California. These are
Yeah.
levels of affordability we've never seen in the United States. And but the reason I think the prices stabilized is there is still that acute housing shortage underneath it. So
Right.
it pushed it too far beyond for a bit is the shock occurred, but then it stabilized just because there wasn't enough supply out west, and active listings have tightened up. And are still most of the western part of the country, especially along the coast, still down around 20% from pre-pandemic levels. Not at levels like the Northeast and parts of the Midwest, but still fairly far down. And especially I mean, look at Santa Barbara. I mean, it's
Yeah.
down 53%. So that means for
That's
every
crazy.
so that means for every two homes that were for sale in Santa Barbara in November 2019, there was one this November. The craziest is you go look at, I mean, these parts of Connecticut.
Dang.
I mean, so that means I mean, that means if it was minus 80%, that would mean for every 4 homes for sale in November 2019, there was just 1 home for sale actively in November 2023. And so that's what I mean about that. You can look at all the forecasts you want, but if the market is stabilized, we don't have a shock occurring like the mortgage rate shock. If we're
Hmm.
stabilized, then the technicals of the market, if you're that far down for actives and inventory, are going to suggest that prices are going to move up. All else being equal, like I'm assuming the economy is where it is today, the next 6-12 months. When I say that, but all else equal, you would assume, given where actives are right now, that big swaths of the country will probably see prices rise this year.
Okay, I like this, man. So then help me understand why people all over the internet are saying we're going to crash, something's going to crash. Now they're finally shifting over and saying multi-residential is going to crash, commercial is going to crash. But some people are still talking about the actual residential market crashing or something weird happening. Why is this?
I think what it really gets to is a couple of factors. One, almost everybody who is over 30, or maybe over 35, if they're they would have been adults then, lived through a almost once in a lifetime event, which was the housing crash. So people know that housing can crash, but to a lot of people, especially the under 45 crowd, that probably seems normal. Like they're like, oh, housing goes up a lot, then it crashes.
Hmm.
Historically speaking, the truth is that what occurred in '07 to 2012 with the bottom
Hmm.
was an anomaly historically. And give me 1 second.
Yeah, no problem, man. I love seeing this. By the way, guys, the data he has, you guys can check it out on the link that I put in there. Just type in Resi Club on Google. You can find
Okay.
this stuff there.
Sorry, I'm back. So that event that occurred was actually a historical anomaly. You've never even seen in the post-World War II era, other than the housing crash, prices even go down nationally 10%, let alone go down 27% like they did during the crash. So I think people, and I think it's fair, I think that's a normal emotion, remember that. And so when they saw the boom occur during the pandemic, people were like, oh, that's what it's going to lead to. Now, to
Got
me,
it.
as a journalist, I covered that boom, and I will say I never ruled out a crash because you just,
Yeah.
especially because I also lived through the last one, and I think everybody was kind of like, kind of paying attention. But
I
and
was
we
freaking out a little bit. I'm like, is it going to happen or what's happening?
And especially when we had that period of destabilization in the second half of 2022, it was like, oh, we're seeing a correction. Let's see how much we get. We did get 6 months of correction, but we didn't get 6 years. The housing crash was 6 years of destabilization. We lived through, at the end of 2022, 6 months of destabilization. And so I think that's one part of it. The second part of it is affordability is so deteriorated that a lot of people can't afford to buy. And so people some of them would like to see prices come down a lot more because they're priced out. They can't afford housing. Home prices have went up so much. And maybe when they had the opportunity, they didn't jump, or they weren't ready, or, they weren't, partnered up with the right person yet, or they didn't make enough money. Their career wasn't far enough along. And then now when they're in that position where they're married, they want to have kids, they can't afford to buy. And so I think there's a natural human response to want prices to come down. So I think that's part of it, is potentially seeing some ghosts and wanting prices to come down. Now, I'm not saying that we can't have corrections, there isn't downside risk, but just as of right now, the market has stabilized in a lot of parts of the country. Most of the country is up year over year, with the exception of parts of Louisiana and Texas. And right now actives just aren't up at a high enough level to put downward pressure on the market.
Got it. Got it. Man, this is really good to see. So then what do you think happens if interest rates go down a little bit more? Do you think then Right. Are you in agreement with what Barbara Corcoran says, where she says, if interest rates come down more, prices are going to skyrocket even higher. You better get in now.
Well, one thing I can't say is I can't rule out the possibility that it heats up more, right? Because as mortgage rates come down, you could potentially see more demand unlocked, and that could outpace the supply that's unlocked. And so there is a possibility that if mortgage rates came down, if days on market came down, actives could come down too. There's also the possibility that, affordability is so strained, even with mortgage rates coming down, that prices could just continue to stay at a normalized growth level, even with a bigger a movement down in rates, even one that's bigger than, like, let's say it's even a point below where we are today. It's
Hmm.
possible that prices might not overheat because even though there isn't a ton on the market, the affordability is still strained. And so the fundamentals being affordability are kind of fighting the technicals being the inventory on the market. So I don't know. We already had that period of overheating in prices. So it's very hard to make another call for more overheating on prices. I don't think that we're going to go back into a COVID level of frenzy. Which one thing to keep in mind is in 2020, once you got the 2% mortgage rates,
Hmm.
affordability was almost at a historical bottom.
Yeah.
Affordability is super low. If today we move down to 5.5% mortgage rates, yeah, there's going to be more activity. There's going to be buyers unlocked, but affordability isn't at anywhere near that 2020 levels or even 2021, just because prices have come up so much. And the fact that, rates, even at 5.5, are still much higher than they were before.
Yeah.
And the asterisk that I put to all of this is that it'll probably vary by market, and there probably could be some places where Barbara's right, especially these places where prices have gone up 7% despite mortgage rates going to 7, and some
Yeah.
places are still up 7% year over year despite all of that. So maybe some of those really tight markets could see a bigger than expected pop. But
Dude.
right now, I'm much more cautious. um, I, I, I'm less bullish than Barbara.
Okay. All right. Well, I'm thinking from your map, I'm thinking that the darker brown areas are the ones we have to worry about if interest rates drop a little more.
I think that's probably right. Now there is the alternative view, and the other view is places like Moody's Analytics and Morgan Stanley, which view as interest rates come up, that churn in the market as more resale activity occurs because people are struggling with eligibility to buy. That
Mm, yeah.
that because the churn actually occurs, that then prices could actually come down a bit just because people selling their home to go buy something new, um, fewer to actually get that activity moving up, prices would come down. They believe. I don't necessarily know if that's true, because if rates came down a good chunk, you could potentially see more buyers come into the market than the supply come in.
Yeah.
Uh, so I don't know. I definitely listen to both camps. And recently when I talked to um, Sean Dobson, CEO of Amherst, and they own 44,000 single family rentals, his view was, you know, he expects rates to come down more, but he didn't necessarily expect prices to rip up higher. So,
Interesting, dude. All right. Well,
and for the market, I think the market probably should root for normalization.
yeah, that's
A
what I'm
period
hoping too.
Boring would be fine. The market would probably love for transactions to come up more, rates
Hmm.
come down more, and hopefully, prices don't go too crazy. I think that would be what the industry should root for, because there has never been, and this is true, while it's not normal for home prices to crash, it is normal for transactions to crash. And every boom in transactions has led to a bust in transactions. And we are in a bust for transactions. So that 2021, that boom, that wasn't good for the industry in a way. Yeah, people can make money on that and stuff, but it comes with a consequence. And the consequence is what we're living with now. and that pullback in resale transactions.
All right, man. Well, thank you for jumping on. I'd love to have you back maybe every like 30-ish days just so you can give us an update. Because you're in this deeper than we are. We're out helping people, but it's very local and you get to see the whole map and you have the
Yeah.
data. So
Yeah, I would love to come on more. Is there anything that I said that you want to push back against, or
no, man, I think you got it right. I think the key is affordability. And I think if the longer the market remains more normal, I think the longer people in general, the population, has a chance to grow in their wages and affordability through the economy. And I think that's important because that's one thing we're not looking at. It's like, how long is it going to take for people to be able to afford things if everything else remains the same, right? And I
Yep.
think you hit that
So
right.
yeah, so the last thing I'll end with is real quick. If I had to sum up the market, I would say there is a big headwind against the market, which is like the negative force, and that's affordability is very strained. And then there is a big tailwind to the market, and that's the positive force, and that is the fact that resale supply and inventory is very tight. Nationally aggregated. Of course, Austin is an exception,
Yep.
being an exception, but that's how I would describe the market. Big headwind, affordability, big tailwind, supply.
Lance, thanks so much. Everyone else, check out Resi Club. Thanks for doing this, Lance.
Thanks, Chris.
I'm gonna see you in 30 days or so, so I'll email you.
Chat soon.
All right, thanks. Bye, everyone.